Hello, I'm David Frazier with Investors Monitor, and this is our daily Investors Insights show where we strive to tell you everything that you need to know but nothing more regarding factors and developments that are likely to impact your investment portfolios. So, today on December 23rd, many of you I'm sure know that we have not recorded these shows for several months now. And the reason being is that we've spent a lot of our time focusing on improving substantially our internet website at www.investorsmonitor.com and in increasing the amount of information that we provide at that site. We now have the site mostly where we want it to be regarding the types of information that we plan to provide on a regular basis, and I'm very confident that any of you that go to that site and explore the site will find that our site is very different than the vast majority of financial market websites. And it's different in the following ways. One is, as I began today's show by saying that we strive to provide investors with everything that they need to know, but nothing more regarding factors and developments that are likely to impact the value of their investment portfolios. You'll find, therefore, at our site, we don't have 15 to 20 different articles on a daily basis from numerous financial writers, journalists, analysts, what have you. We don't try to comment on every little thing that's going on in the financial markets, whether it's the U.S. financial markets or other markets around the globe. Or we don't comment on every geopolitical development and every economic development. And we do not for the following reasons. And that is because we have found, or at least I have found, that over the past approximately 30 years of investing, speculating, and trading in the financial markets, that repeatedly over that 30-year period and going back in history and studying how the markets acted really even up to 100 years ago, there are really only a few major high-level factors that affect financial markets in the value of investment securities. Those being economic factors and developments. Number two, geopolitical factors and developments to a very, very small scale. Geopolitical factors tend to affect the financial markets only on a very short-term basis, or do not tend to have any lasting impact. And thirdly, the corporate operating results, which should not be surprising at all. I mean, if you're speaking of stocks, any given stock price is ultimately determined by the level and direction of the company's underlying corporate operating results, its revenues and its earnings. So those are the topics that we focus on through our internet website and the type of information that we provide to visitors to our site, as well as to persons who subscribe to our investment journals. So, having said that, I'm guessing that I might be all over the place in today's web TV show, and the reason being is I just haven't done these shows for a few months. So let's begin, however, by going back and commenting on the Federal Reserve's decision last Wednesday to raise the target range for the overnight lending rate, the interest rate that commercial banks lend to one another on an overnight basis. And let's start off by just saying, you'll hear journalists in general, financial market participants, so-called analysts, portfolio managers, economists, they'll say that the Fed raised rates or the Fed lowered rates. Well, the Fed does not raise or lower interest rates. It has control over only one interest rate, and that's the overnight lending rate that commercial banks use to lend funds and or borrow funds from one another. And now that interest rate will tend to have some impact, but very little actually, on other interest rates, whether it's on any type of lending or borrowing rate. It will tend to have some impact, but very, very minimally. The Fed can only really control that overnight lending rate and only have minimal impact on other lending rates. Having said that, the Fed is, I'm sure anyone that's watching and listening to this show is well aware, the Fed stated last Wednesday that it had decided to raise the target range for the overnight lending rate, that is the Fed funds rate. And here's exactly what the Fed said. Please give me a moment. I'm going to quote this for the reasons that the Fed decided to raise that rate. And please forgive me, I can't find it. It's going to give me a moment. Here we go. The Fed said, as one of its primary reasons for raising the Fed funds rate, that, quote, household spending and business fixed investments have been increasing at solid rates in recent months. One more time. Household spending and business fixed investment have been increasing at solid rates in recent months. Well, that's very, very interesting. I find that very interesting because I guess it depends on how you define what the word solid means. I mean, generally when solid, we think of strong at a healthy rate. And it also depends on how you define recent months. Well, what's recent months? Is that past 2 or 3 months, past 6 months? I'm not sure. But here are some facts regarding household spending and business fixed investment here in the United States. Personal consumption expenditures, that is household spending on a broad basket of goods and services, the rate of increase, household spending has been increasing, and it generally does almost during any environment until you get into a deep recession or a depression. And the reason being has a lot to do with the population's growing. It's a lot of factors. I'm not going to get into all of that. But the rate of increase in household spending, and that is in inflation-adjusted personal consumption expenditures, trended lower over the past 5 months, trended substantially lower. So households, that's a fact. And the Fed's well aware of this. So when they say that they decided to raise the Fed funds rate because household spending has been strong, well, if something's, if the rate of increase in household spending is slowing down, I don't consider that to be strong. Secondly, another fact, business fixed investments here in the United States slowed during each of the past 3 quarters. During each of the past 2 quarters, they slowed, meaning the rate of increase slowed. And during the most recent quarter, ended September 30th of this year, business and fixed investments actually declined compared to the same period a year ago, as well as, the same quarter a year ago, as well as the quarter ending in June. So household spending, the rate of increase declined during the past 5 months, month after month, and business and fixed investments, not the rate of increase, but the total, just not the rate of increase. There was no increase in the most recent quarter. They declined. So I don't know what the Fed's talking about. But in reality, I do know what the Fed's doing. The Fed's chose its words very, very carefully. And that's because they didn't have any economic reason to raise the overnight lending rate. They raised the overnight lending rate, in my very experienced opinion, for one and only one reason. And that is because financial market participants and portfolio managers and economists have been talking about this for about 1.5 years now. They've been claiming almost month after month that they expected the Fed to raise rates. I don't know. I guess they're out on the golf course. They're not doing their homework because there's there's no reason during any of that period for the Fed to raise rates, or that is the overnight lending rate. They only raised one rate. So my thinking is that the Fed raised its overnight lending rate, the Fed funds rate, the target range for the Fed fund rates, for only one reason, and that is just to get it out of the way and to meet the expectations of these journalists and portfolio managers and investors in general. Now, even though the Fed raised the overnight lending rate, I'm very, very, very confident that we're not going to see another interest rate hike by the Fed for at least several months, and maybe not for another year, but at least for several months. And the reason being is quite simple. Number one, the readings on numerous leading economic indicators for the United States suggest that the pace of economic growth here in the U.S. is going to slow over the next few months. That's number one. Number two, the Fed said repeatedly over the past 12 months, quote, even after employment and inflation are near mandate consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below levels the committee view as normal in the long run. So the Fed's, has told us this repeatedly, really for about 12 months now. And thirdly, the Fed said during last Wednesday's announcement regarding its decision to raise the Fed funds rate, that it, quote, it expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. And it went on to say the Fed funds rate is likely to remain for some time below levels that are expected to prevail in the long run. So, okay, the Fed raised the target range for the Fed funds rate. Who cares? And my research has shown that historically that interest rate hikes by the Fed really don't affect the overall economy or the financial markets in any negative way until at least several rate hikes have been implemented, until those interest rates tend to get relatively high. So, put all this, just ignore all this nonsense about interest rate hikes. It's really is, it's a, I can't think of the word I'm trying to find, but I can't think of the word I'm seeking, but it's a distraction. That's what I wanted to say. It's noise. It doesn't really matter. Here's what does matter. The U.S. economy, or numerous economic indicators for the U.S. economy, as I said a moment ago, the readings on those indicators have been worsening, meaning that they're suggesting that we're going to see a slowdown in the pace of economic growth, and that's right up to the Fed's announcement last Wednesday. And readings on some very significant indicators since then, over the past several days, also were rather negative. For example, the Federal Reserve Bank of Philadelphia announced on December 17th that its survey of manufacturing executives in this region of the country indicates strongly that manufacturing activity will decline during December. And manufacturing activity slowed considerably in the Philadelphia area over the past 6 months, and now the latest surveys indicate the manufacturing activity there likely declined during December. Secondly, U.S. Housing, let me back up a bit. Sales of previously owned homes here in the United States declined sharply, very sharply, during November. These are factors that are very, very important: manufacturing activity and housing market activity. And the reason they are, history clearly shows that there's a very strong relationship, correlation between the direction of the overall U.S. economy and economic activity in the manufacturing sector and housing sector of the economy. So if we're seeing a slowdown in manufacturing activity, or even declines in manufacturing activity over the past couple of months, and a likely slowdown in the housing market, well, it's pretty clear the pace of economic growth is going to slow during the months ahead. So why am I talking so much about this? You're listening to this show hopefully because you're a financial market investor, and you might be thinking, why is he talking so much about the economy? And the reason being, for some of you, many of you well know, I should say, is that, not surprisingly, the direction of the financial markets, whether it's stocks, bonds, real estate, precious metals, commodities, are determined largely by overall economic conditions and the pace of economic growth. And that should not be surprising at all. So I'm not going to get into that. Hopefully you understand the reason for that. So let me go on to say that, secondly, we here at Frazier Mayer Research LLC, the providers of Investors Monitor and InvestorsMonitor.com, unlike many financial market analysts, portfolio managers, pundits, people who speak regularly about the financial markets, we don't focus, or we don't, I shouldn't say focus, we don't employ just one approach of analyzing the financial markets and use only one approach to make recommendations regarding investing, speculating, and trading in the financial markets. Instead, we look very heavily at economic factors and developments. We pay attention to geopolitical factors, but as I started off this show, not much attention, because history has shown clearly that geopolitical factors have no lasting impact on the direction of the financial markets. So we look mostly at economic factors and developments, but we don't leave it at that. We also look at what's actually going on in the financial markets. What is the trading action telling us? And if you were to look at numerous so-called technical indicators, that is, at charts of the trading action in the financial markets, whether it's the percentage of stocks that are advancing in price versus those that are declining in price, or the percentage of stocks that are trading above their 200-day moving average, or financial markets participants' sentiment regarding the future direction of stock prices. Let's see. If you look at almost any so-called technical indicator, that is, charts of the trading action in financial markets, they support what economic factors and developments are telling us. So we also look at these trading action statistics, because if there's if the trading action statistics are telling us one thing, for example, suggesting that stocks are going to move higher, but economic factors are telling us that stocks are going to move lower, well, we back up and do more research. We reevaluate. So what we want to see is what's going on in the financial markets to concur with what economic factors are telling us. And that's exactly what we've been seeing for several months now. And we have charts of numerous so-called technical indicators, as well as more than 100 economic statistics that are available at our internet website at www.investorsmonitor.com, and for absolutely free. It does not cost you a penny to go and look at those charts and to actually download the data and use the data to do your own analysis. Lastly, we don't just leave it once again at just looking at the technical indicators or looking at economic factors. So instead of just doing a top-down analysis and approach, we also do a bottom-up analysis and approach. And what I mean by that is not just looking at what economic factors and how they're likely to impact stock prices and bond prices and precious metals, commodities, real estate, but we also look at how are publicly traded companies actually performing regarding their sales revenues and their earnings. And not surprisingly, looking at the financial markets from a bottom-up approach by reviewing more than 600 quarterly earnings announcements from U.S. publicly traded companies over the past few months. We do this every quarter. Well, those results are telling us the same thing that the economic factors have been telling us, and that is corporate earnings declined during the most recently reported quarter, during the quarter ended September 30th this year, on an aggregate basis. Well, if you're seeing, once again, corporate earnings or losses, the corporate operating results are what ultimately determine the direction of leasing stock prices. Well, if corporate earnings decline, you're probably going to see stock prices trend lower. So I've probably talked for, I'm not even sure how long, but I'm guessing probably about 20 minutes already. So I think that's enough for today. I hope you've gotten something out of this web-based TV show, and I encourage you to come back every day of the week and to watch and listen to our show. We don't waste time. Sometimes these shows might be 20 minutes. Sometimes they might be 30 minutes, and sometimes even longer when we get into showing you, going over charts, showing you on our TV show charts of indicators that we review and analyze on a regular basis. And sometimes these shows might only be about 3 or 5 minutes in length. We don't rely on advertisers to produce our shows. So we just, we don't have a specific time for the length of our shows. Rather, we just we strive to tell you everything that you need to know, but nothing more regarding factors and developments that are likely to impact your investment portfolio. So, if you're not watching this show on our internet website, I encourage you to visit our site at www.investorsmonitor.com. And if you have not already subscribed to our free weekly commentary, I encourage you very strongly to subscribe to that commentary. It does not cost you a penny. So I thank you for listening and watching, and I'll speak with you again tomorrow. But before doing so, because many of you are probably going out of town visiting family and friends over the holiday season, most importantly, I very sincerely wish all of you a very Merry Christmas, a very Happy Hanukkah, and just a very joyous holiday season, and I hope you enjoy spending time with your friends and family. Thanks again. I'll speak with you again tomorrow.